Hello and welcome back to Dividend HQ. In today's video, we're going to be talking about SCHD and whether or not it's fallen behind other dividend ETFs. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos we post here on the channel. And feel free to comment down below if you're adding SCHD to your portfolio. Without further ado, let's get into the video. So I'm going to be posting more often. I'm going to try to post at least every other day on this channel. And I'm going to make videos about dividend ETFs, investments, certain stocks. And I'm just going to continue to try and remain consistent. I know I've been falling behind on videos lately, so I'm going to keep posting as much as possible. But let's get into the video itself about SCHD and why it's a great choice even though it's falling behind other dividend ETFs. Over the past couple of years, many investors have questioned whether or not SCHD or the Schwab U.S. Dividend Equity ETF has lost its edge. After all, the fund, which was once considered one of the best performing dividend ETFs, has lagged behind the S&P 500 and even some of its dividend peers. But while recent underperformance has raised eyebrows, I still believe that SCHD remains one of the most solid, dependable, and intelligent long-term investments available today. In fact, I'm actually adding $15 a week to my SCHD position, and here's why. The first reason is short-term underperformance doesn't erase a decade of strength. SCHD was launched in 2011, and over the long run, it's delivered strong returns, averaging around 11% annually since its inception. Even though it's recently underperformed compared to tech-heavy indices like the NASDAQ, that's largely because SCHD focuses on high-quality dividend-paying companies, not speculative growth names. The stock market often moves in cycles, and over the past few years, high-growth tech stocks have dominated, but historically, dividend stocks shine when growth cools off or when the economy shifts towards stability and value. SCHD's fundamentals haven't changed, it's temporarily just out of favor. And as Warren Buffett previously said, be fearful when others are greedy, and greedy when others are fearful. This underperformance period may actually be an opportunity to buy SCHD at a discount before the next rotation into value and dividends. SCHD isn't just chasing trends, it invests in high-quality, profitable dividend-paying companies with strong balance sheets and consistent cash flows. These are the kind of companies that you would want to invest in. The ETF screens for return on equity, dividend growth, and financial strength, meaning that every company inside it is battle-tested. Its top holdings include names like Pepsi, Broadcom, Home Depot, Amgen, and Verizon, companies that have weathered multiple recessions and market cycles. These businesses aren't flashy, but they generate real profits and they consistently reward shareholders. In a world where speculative stocks can soar and crash in the same month, owning reliable dividend payers feels like the smart way to sleep well at night. One of the best reasons that I'm sticking to SCHD and adding to it on a weekly basis is its dividend consistency and growth. SCHD currently yields about 3.5%, which is significantly higher than the S&P 500. But the real power is its dividend growth rate, which has averaged around 11% annually over the last decade. This allows your income to double roughly every 6 to 7 years, assuming that similar trends continue. For long-term investors, especially those focused on building passive income, this compounding dividend growth is a game changer. Even if the share price moves sideways for a while, those rising dividends continue to increase your total return, and they can be reinvested to buy even more shares. By investing $15 a week, I'm practicing on dollar cost averaging, which is a proven strategy to reduce the overall emotional roller coaster of trying to time the market. And here's the beauty of it. When SCHD's price dips, my $15 buys more shares. And when it rises, I buy fewer shares. But my existing ones grow in value, and over time this averages out to my cost basis, and it allows me to build a position steadily, regardless of short-term volatility. But it's not just about how much you invest, it's about consistency. $15 a week might not sound like much, but that's $780 a year. Add dividend reinvestment and compound growth over 10 or 20 years, and that can grow into something truly substantial. SCHD's expense ratio is only 0.06%, which means you're just paying 60 cents a year for every $1,000 you invest. That's cheaper than nearly all active managed ETFs and many regular ETFs as well. You don't have to worry about analyzing dozens of stocks or chasing the next hot pick. With SCHD, you're getting exposure to a curated basket of high-quality dividend companies, automatically rebalanced and managed for you. It's very simple, low cost, and effective, which are core traits of a great ETF for long-term wealth building. Even though SCHD might not be the best performing ETF every year, its real magic lies in time and reinvestment. Every single dividend payment, when reinvested, buys more shares, which in turn then generates more dividends, creating a snowball effect for compounding your returns. This is how wealth quietly builds in the background. While others chase quick returns, disciplined investors often accumulate income-producing assets. By consistently adding my $15 a week and reinvesting the dividends, I'm building a future income stream that can grow faster than inflation and provide me with stability and income for years to come. When most people mention that SCHD has recently underperformed, they mean that it didn't keep up with the S&P 500. But if you remember, the S&P 500 has been driven by a handful of mega-cap tech stocks. That's not sustainable forever. SCHD's focus on diversification, value, and dividend strength means that it may lag during tech booms, but often holds up better in downturns. In fact, during volatile or declining markets like 2022, SCHD has historically shown smaller drawdowns than the broader market, which is exactly what you want when you're investing for the long term. At the end of the day, investing isn't about just chasing the hottest stock or predicting the next bull run. It's about owning great businesses, consistently adding to your position, and letting time do the heavy lifting. SCHD embodies that philosophy. If you're diversified, focused on shareholder returns and dividend growth, by committing $15 every single week to SCHD, I'm just buying an ETF that has the habit of long-term wealth creation. Yes, SCHD has recently had a rough patch, but long-term investing isn't about short-term charts. It's about fundamentals, discipline, and patience. I don't need this money for several years down the road, so investing it in SCHD is probably the wisest choice. When I decided to start investing $15 a week into SCHD, it wasn't just because $15 is a huge amount or I'm expecting instant results. It's because I understand that steady, consistent investing beats one-time perfection. The truth is, most people lose money in the market not because they make bad investments, but because they fail to stay consistent. Dollar cost averaging helps change that. The market is always noisy. There's new ETFs, flashy returns, and daily predictions, but the people who actually build wealth aren't the ones chasing the recent trends. They're the ones who show up every single week, quietly buying more shares no matter what the headlines say. That's what $15 a week is for. It's a commitment to consistency. It's saying that I don't care what the market does today, I'm investing for the next 10, 20, or 30 years. Even small contributions compound massively over time. At a modest 8% annual return, $15 a week grows to roughly $12,000 in 10 years, and over $55,000 in 30 years. And not counting the rising dividends SCHD pays along the way, that's a quiet power of compound returns. Let's be honest, nobody can time the market perfectly. You can study charts, analyze indicators, or follow every financial YouTuber out there, but you'll still never know when the perfect moment to buy is. Dollar cost averaging eliminates that stress completely. By investing a fixed amount every single week, you automatically buy more shares when prices are lower, and fewer shares when prices are high, Over time, this averages out your cost per share, and it smooths out the volatility that scares most investors away. It's one of the simplest ways to turn market dips into opportunities instead of something to fear. Every drop becomes a discount day over your long-term wealth plan. One of the biggest reasons I chose $15 a week instead of a larger, irregular deposit is that it's automatic and it's sustainable. It's something that I can set and forget and let time do the compounding over years and decades. By automating the process, I remove the emotion from the equation. I don't have to decide whether or not now is a good time to buy. I just know that every single week more of my money is going into something, and that's going to build long-term value. That's how the true real wealth is built, not from hype, but from habit. Automation allows me to reinforce a mindset that investing isn't just an event, it's a routine. It's like going to the gym or saving for a vacation. It becomes a part of my lifestyle and not just a financial task. A lot of people hesitate to invest because they think they need to start with hundreds or even thousands of dollars. But the truth is, consistency beats quality early on. Investing small with $15 a week isn't just about the size of the investment. It's about building a system that allows money to grow on automatic autopilot. And because SCHD pays out dividends that can be reinvested, every single share purchased today helps buy more shares tomorrow. The compounding effect means that even small weekly amounts could snowball into something more powerful over time. In 10 or 20 years, those contributions will likely be generating hundreds of thousands of dollars a year in dividends, all while the underlying shares keep appreciating. That's what financial freedom looks like: slow, steady, and inevitable. If you guys enjoyed today's video, please be sure to leave a comment down below if you're buying SCHD in your portfolio. Love to hear from you in the comments. And leave a like on the video and subscribe in order to stay up to date with the latest videos we post here on the channel. Thanks for watching, and I'll see you in the next one.